All right, so we're going to start, let's go to the second learning objective, and or the second unit. And we're going to start now looking toward business activities, and these business activities are going to be the way we build financial statements, whether we're looking at the income statement, balance sheet, statement of cash flows. These business activities will become critical. So that if you look at this first diagram, you know, you're looking at the red arrows coming in. Those are the external forces that would impact the company's strategic plan. And the strategic plan, obviously, the main goal is to, as we'll see in the next slide, to build value for shareholders. And then we take steps in that, we have certain goals that we want to reach, and we take steps to meet that. And those steps will involve, the strategic plan to execute it is going to involve achieving goals, and those goals will involve operations, investing, and financing activities. And everything we do in financial accounting will revolve around those three cycles or activities: operating, investing, and financing. Now, what I like about this book, it's one of the only books that actually builds it that way, and that's the way really we have to think about the way we build financial statements. So the first thing we would do, obviously, is setting up our goals, and then once we have our goals, our strategies. And as I said, to achieve those goals, the strategic plan will outline how to achieve that, and that's where we will build in our strategies for operating, investing, and financing activities. Now, we'll start with investments, because obviously this is where we have to start a business, we would have to acquire economic resources that would be used to produce our goods and services. When we look at the balance sheet, we're going to find that investments will actually be a use of funds. We're going to talk about this in a bit. So if we look at the balance sheet itself, which we're going to get to, or the accounting equation, going to be our use of funds, and that's where we're going to have our investments. So we're going to go out, we're going to acquire assets that we're going to use in the business that will help us provide goods and services. We have short-term assets, of course, which are used up within 1 year or operating cycle of the business. They're used in day-to-day operations of the company. And then, of course, we have longer-term assets, which we're going to be employing for long-term growth. When you look at the cycle, and we have to be very careful when we get to the cash flow statement, but when we look at business cycles, we're going to see that the short-term assets are converted every year. So it's like a cycle. So if you look at, again, nothing to worry about right now, but if you look at the way a company is going to grow over time, you know, the short-term assets, you're going to buy inventory and sell it, for example, and you'll have many cycles over time, and the longer-term assets would be here. So this would be like more like your plant investment. This would be more long-term. And short-term, this would be something like inventory. So inventory will cycle. You start the year off. If you ever worked in retail, you know that you start the year off at its lowest level, then you build up inventory and then sell it. And that cycle goes on from year to year. Although you may not think of it as an investment, the inventory is going to be used up quickly, hopefully. So, and then of course the long-term assets are for growth over a longer period of time. Now, when you look at a mix of assets, and this is what I was mentioning earlier, if you think about the proportion of short-term to long-term assets, I mean, take a look at the difference between, for example, Verizon and Nike. And later on in the course, we'll look at Nike's operating cycle itself. Why why is it? I mean, if you read the book, I think you have the answer, but why is it that Nike has such little reliance on plant, equipment, long-term assets, factories, warehouses? Yep. Andrew?
Don't they hire other people to do it?
Yeah, they outsource.
Yeah.
Yeah, they outsource. Yeah, so if you outsource, you can limit the amount of long-term investment that you need. Verizon, and by the way, it varies by company, but Apple does a lot of its own manufacturing, or at least, a lot of its own, or they have a lot of long-term assets. Where you would have Verizon, obviously, with cell towers and a lot of that equipment, they're heavily invested in that equipment. So every company will be different, and by the way, these, I should say that these comparisons are not valid because they're different industries. So you can't say that Verizon has too much long-term. I mean, if you look at other carriers, it may be right in line with them. So you don't necessarily know. But again, more plant assets are needed in some operations than others. Now, that's when you look at the balance sheet, when you look at the assets, you look at them as uses of funds. The next question is, where do you get the money to buy those assets? And this is where we're going to have the sources of funds. And here, these are our financing activities. And financing activities would be debt and equity financing. So these are the ways that the company acquires its assets. It either borrows or it will raise equity capital. So that's why a lot of you have seen this already. And I'll show you the way the book does this in a minute. But liabilities and stockholders' equity, you have debt financing here, for example. And of course, equity financing. And what else? Where else could a company get financing to support its operations?
Profits.
Profit, yeah. So internal funds that'd be your retained earnings. That'll be your retained earnings. So the two sources of external financing, and that's what I'm saying here, these are external. These are internal sources of funds. So externally, you borrow, or you have equity financing. Internally, you use your own funds, retained earnings. And there is a cost of using your own funds as well. And this, by the way, is the fundamental accounting equation, or the balance sheet equation, that assets would equal liabilities in stockholders' equity. But what I'd like to do initially is make sure you see this as a sources and uses of funds. Now, it's sort of counterintuitive to some to say that assets are using up resources, but it's a fact or a reality. So this is the accounting or balance sheet equation. And when we look at proportions, different debt and equity financing, it would sort of make sense that Verizon would have more debt in its capital structure. You know, financial planning means that you have to look at the optimal mix of debt and equity. When you look at Verizon, they are able to borrow more on a long-term basis because of what? They have long-term assets as collateral. I mean, it's almost like you and I, you know, you may be renting an apartment and I may have a house with a mortgage. I got that mortgage because my house is my collateral, so I've got a plant asset that I could use to support that debt in the event that the debt payments are made. And that's the way you have to look at the companies. And again, Apple, you notice they're just at about 50-50. And as I said before, if you look at the same diagram in their debt equity mix, you know, 8 years ago, there was almost no debt in their capital structure at all. They were, you know, almost 100% equity finance. Now, a debt equity ratio, once again, you can't take this out of context. You'd have to look at Verizon with other, like AT&T and other carriers of cellular and phone service. And that's very, and by the way, if they have an airline up there, no, they don't. But if you have an airline, heavily debt financed. And that's why they fluctuate so much in terms of economic conditions. The value of an airline would be very, very sensitive to economic conditions. So when you look at the optimal mix, and we'll get, you know, obviously we'll do the debits and credits, and that's going to be a big part of the course. But when you look at the optimal mix of debt equity financing, it's going to be important, especially when we do a lot of the accounting. You know, sometimes whether or not how the debt is recorded is important. So when we look at the definition of an asset in a moment, an asset is a economic resource that is owned or controlled by the firm. Owned or controlled. We'll see that. You don't have to copy it. Owned or controlled. So when you look at an asset, if you don't own it, why is it on your balance sheet? How do you control an asset without owning it? You lease it, right? It's a lease. So if you lease a factory, or if you lease an apartment, or if you lease a car, so if both of us had delivery services, and I buy the car and you lease it, we're still doing the same thing. We're generating profit. So if I was analyzing your company, and I was going back to the other slide, looking at assets, and let's say we treat the car as a fixed or a plant asset, if you leased a car and I kept it off your balance sheet, you'd be generating profit with almost no assets, no plant assets. And I have the plant asset on my book as I bought it. So obviously, to even the playing field, leases, because it does the same thing as owning, go on the balance sheet. And the same thing is true on the debt side. Lease liabilities go on the debt side as well. So whether or not economically or legally, I should say, remember we're talking about economic substance, whether or not you own this asset, it's still used to generate profit. And it's still a legal liability. It's still, you know, if you don't pay that lease, you could have some implications. So whether you own the asset or not, it's still an economic resource. And the same thing's true here. I mean, what if Nike didn't borrow as much, but they leased everything, right? I mean, might as well put that debt on the books. We've got to equal the playing field. And we'll talk all about that when we get to those topics. So when we now look at the accounting equation, that's the way we want to think about it. We want to say that assets are a result of investing activities, and they are sources of, the use of funds. The sources of funds, as I said, would be your creditor financing, those are your liabilities, and your owner financing, which would be your stockholders' equity. So your creditors, and by the way I like to look at this is also another way we might want to look at this is that assets have to equal equities. if you look at this from from a macroeconomic view, all throughout the economy, every asset has to be claimed by someone. So that we do the same thing on a micro level at the firm. So assets are economic resources, equities are claims against economic resources. Creditor claims or financing, and owner claims. Or financing. And of course, these are liabilities. And I'm just going to abbreviate this. This is stockholders' equity. And that's how we get that's how we build this balance sheet equation. So every asset has to be claimed by someone. It's either a creditor or an owner. So that we now look at the converting that, investing activities or economic resources or assets. Liabilities or non-owner claims or outsider claims. And of course the owners are how do I do that? So Nike, that's an example of Nike's balance sheet, where assets are $18,594,000,000. Liabilities are $7,770,000,000, and then of course their equity, $10,824,000,000. And that is the balance sheet equation. Now we'll be pushing numbers through this equation throughout the course, but that is their balance sheet equation. All right, so that's the model that, again, investing results in assets, uses of funds, sources of funds in here, and there's one other source of funds, and that is going to be through retained earnings, as we said. So that when you look at the internal source of funding, that's going to be retained earnings, and that's going to come from our operations. It's going to be from our operating activities, so that the production, the manufacturing, the selling of products and services generates profit, and profit that is not paid out as dividends is going to be the retained earnings. Retained earnings could also be used as a source of funds to help finance operations. And of course, we know that obviously we have to generate revenue, and to do that we have expenses. We'll talk about those expenses, salaries, materials, cost of logistics, and then of course we supply them to customers. So we've got revenues and expenses that would result in income. Now, retained earnings is the historical record of the company's income that was not distributed as dividends. So when you look at retained earnings are revenues minus expenses or operating profit that was not paid out as dividends. That's what's retained by the company. So retained earnings, when you look at the primary change in retained earnings, is the change net income minus dividends. That's the income that we earned over time that we did not pay out to our stockholders. Now, just one other point, and we'll take some more questions. Hopefully we get more than 26 people in. So these are your revenues. These are some expenses, minus expenses, that would give you your net income for the period, minus dividends, that's retained by the company. Those retained earnings can be used to finance operations. So, when you look at a company with very little debt financing, the equity financing could be some sales of stock. It could also be from using internal funds as well. And there is a cost of using internal funds. There's opportunity cost there as well. Not knowing whether or not the company's making best use of those funds. They may have alternate investments. But just one other thing, just to make sure we understand that which of these two, and a lot of you know this already, but you have two claims here. You have owner claims and creditor claims. Which is the senior claim? Which has priority? Creditors or owners? Creditors, right. So the creditor's claim is a senior claim, and that's why we sometimes look at stockholders' equity. Sometimes call that net assets. And that's because it's assets minus liabilities. All right, so any questions on the 3 cycles? I'm going to ask you some questions. And as I said, these are more practice questions than anything else. Anything on operating, investing, and financing activities? Now, we are going to use this equation as the primary, the accounting equation will be the primary basis for recording transactions once we get started. All right, so if you don't have any questions, then I'm going to ask you a couple of these. And again, I just want to make sure, again, as a test that everything's working. And then, of course, there's your income. Okay.